Welcome to the Daily Update, where I'll go over the action in the market for Friday, June 9th, and then we'll see how things look for Monday, June 12th. For those of you that watch these videos on a regular basis, I'm going to sound different. The screen's going to look different. I already recorded this video once, but I'm having trouble with my main computer right now. And it's a really good computer, but there are two major faults behind the computer, and one of them is the power unit. And I'm having trouble with that again. So for the foreseeable future, I will have to do the videos using Zoom to record them. Please note that this will all be take one. So you're going to get my fumbled words, you're going to get my pauses, you're going to get just the mistakes that I make and so forth. So I apologize in advance for that. All right, let's go back and quickly go over what happened on Friday. We're still looking positive. There are some negative things in the background that we need to be aware of, but overall, the main concern right now is getting above that 4,300 level. And then on Friday, we were able to get up and almost reach the August 2022 high. Those are some serious overhead points of resistance right now. We are still positive. There are still a lot of things that we have to worry about. But if the market's really going to go up from here, we need to deal with those two upper levels. Now, before I get in and look at the charts and discuss everything, I will be using a backup computer, not only for this video, but for the weekly video and the intermarket analysis video and the deep dive video. The video might be a little longer than usual because I can't edit out all the useless stuff that I say or the mistakes that I make. I just have to turn on the button and go for it. I do have a supplemental video that I posted just about a week ago. It has to deal with hedging. We also call that protection, and how you can severely reduce any losses. And in some instances, the worst thing that can happen is you will break even. And I go through and discuss that in the video. I do have a PDF that I will be uploading into the description. So if you're having trouble seeing the charts, you can download that and follow along. If that's not cutting it for you, please contact me and we'll try to come up with some other alternative. I do have a private Facebook group where I like to post some things. Usually it's not that much more than what I talk about in the videos, but sometimes folks are not able to watch the videos every day. Then I do have a poll that I will be reposting this coming weekend. In the weekly video, I'll go over the results of the poll. And then if you can't find me on YouTube for whatever reason, I also post on Rumble, and right here is the channel. So let's go back and talk about what happened. Right at the open, we had a higher open. Remember, it's the amateurs who open the market. It's the professionals who close the market. Everybody's getting all hot and bothered about what the market's been doing lately, especially the tech sector. If the letters AI are anywhere in the equation, everybody's running towards that right now. And that feeds over into the S&P as well. We actually opened above 4,300 and we got up above R1 at 4,308. You notice that number, above 4,300. We went all the way up to R2 at 4,321. Unfortunately, that was the high for the day. We came down from that and never got back to that spot again. Prices then fell from R2 down to R1. We found support at the unchanged level. That is a built-in support or resistance level that we have every day. We came right down there and then turned around and started going back up. We rebounded back up to R1, and then later in the day, we fell back and closed slightly positive. We were up 0.11% on below average volume. That could be kind of encouraging. We saw most of the volume more early in the day, and it's like the smart money, they decided to have a 3-day weekend. So they didn't really want to run the market either up or down. Our technicals were still positive, but we are short-term overbought. That has not been worked off yet. We're a little bit intermediate term overbought. We're still looking okay in the long term as long as we're above the 200-day moving average. The debt ceiling issue, that's done now. So now we're shifting back over to this inflation and interest rate concern. And this coming week is going to be a big one. We have CPI coming out on Tuesday. We have PPI coming out on Wednesday. We have the Fed making their announcement at 2 p.m. Eastern. Then we have retail sales coming out on Thursday, and we'll get consumer sentiment on Friday. So all the economic stuff that we didn't get much of last week, well, we're going to get dumped on in the upcoming week. What are some comments that we can make? We did test 4,300 and the August 2022 high, and I'll show you that when I look at the intraday chart, but then we fell back from that level. We're a little too extended right now in the short term to really take a run at that. Doesn't mean we won't at some point. The market just is not ready for that yet. 4,300 is providing overhead resistance. You can also say the August 2022 high. Now, on a positive side, from the October lows that we set on a closing basis, we have now climbed 20% from that low. And that's the technical definition that we have now started a new bull market. We'll have to see how long it lasts. If we fall back down below being up 20%, we'll be out of that new bull market, but it is showing that things are turning more positive. The mega caps, both on Thursday and Friday, they were the strong areas where the mid caps and small caps were stronger. Well, not on Monday, but on Tuesday and Wednesday, they did really well. They kind of took a back seat on Thursday and Friday, and then the big boys came in again. On a short-term basis, we have the Stochc RSI, the Williams percent R, the CCI 14 and 20, the stochastics, and we're just barely looking extreme with the standard deviation chart. And I'll show you all of these. Intermediate term, we still have the Sean trend meter, and it's not quite there yet, but the VIX 9 period is something we want to keep an eye on. The dollar declined and interest rates were up. We have the 30 to the 5. That's back on the list now. It had gone away, and now it's back. And all of the other yield curves still remain inverted that are in this list. Sentiment is still extreme positive. We're at 77. When we get to 75 and above, that means we're getting a little extreme, or what they say at CNN is greedy at that point. I look at it as more as extreme positive, where we had been at 76. Our trend is still positive, and believe it or not, the green line on the ADX is actually turning up. We are in a trend. The moving average and the ADX are both above 20. I'm keeping our bias at mixed until we can get above the 4,300 level, and even better, that August high. The market's going to really have a difficult time really lunging forward. And I'm also keeping our momentum at mixed. There's so many variables coming up in this week that the market could latch onto and run things higher, or they could justify taking things lower, so that we would just want to be on guard. We didn't have any economic reports that came out on Friday. Looking at some isabelnet.com blog charts, this is kind of self-explanatory. Well, on the right-hand side, you have the top 10 mega caps, and they equal about half of the market. The orange side on the left are the other 426 stocks that they used in this study. Now, S&P 500, there are actually, last time I checked, 505 stocks that make up the S&P. So there's a little bit of cherry picking going on here. You add 10 to 426, you don't get 500. But this just gives you an idea that the big boys, the really monster companies, they're the ones really leading things right now and taking charge of the overall market. Also, they say that Friday in 2023 is better than any other year for stocks. Way over on the right-hand side, and I don't have the laser pointer when I do this, we're up 105.2% on Fridays. We have the euphoria meter. Have you ever heard of that before? Well, it's the red line where it had been declining throughout most of 2022. It finally hit bottom, and we're starting to turn back up. This black line is the S&P 500. And when this red line is going up, that's more positive for the market. Then I'm not going to go through this whole mess right here. This is like a checklist, and all these things over on the left are things that you need to freak out about, and other times when these boxes were checked. Comparing it to right now, and some of those boxes are checked. You might want to pause this and look it over. It's also at isabelnet.com, so you can go look at this yourself if this isn't clear enough for you. Morgan Stanley came out with their June 2024 price target. Isn't that nice? A whole year from now. If we have more of a bullish or positive environment, the earnings they think should be up around $253. That applies to the S&P 500. That would then give us a PE ratio of 18.6. That equates into about a 4,700 level for the S&P 500. That's about 10% higher than where we're at right now. If things just kind of stay the same the way they have been, we would come in at $239. That would give us a PE ratio of 17.6. That equates a little bit of a drop below where we're at now at 4,200. That would be down about 1.7%. If things really turn ugly on the earnings front and go all the way down to $222 for the entire S&P per share, then we would have a PE ratio of 16.7, and that would take us down to 3,700. That would be a 13.4% decline from where we're at as of June 5th. Then this is showing that corporate clients that are buying back stock, the dark blue line is the 4-week average, and that's declining. The lighter blue line is the year-over-year change, and they're both declining right now. That could be a little bit of a warning sign, because if you work for a company where you can buy and sell their stock and you think, if I wait 6 months or a little bit down the road, maybe the stock will be cheaper and I can buy more stock. So just something to be aware of. We're also looking at real estate. The blue line with all the little dots, that just shows how housing has really been going down as of late. We're keeping an eye on the Fed. They're going to be meeting on Tuesday, and then they'll make their announcement on Wednesday after they finish meeting. There's a 71.2% chance that they're going to leave rates exactly where they're at right now, according to the market. It's actually declined a little bit. That's the dark blue column right here, where it's actually been dropping off just a little bit. Some of these economic reports that have been coming out are a little stronger than the market really likes. And so the camp over here on the right that thinks they might raise rates 25 basis points, starting to get a little bit bigger. Let's go in and look at our charts. First intraday, where we did gap higher up to R1. We shot up to R2. That was the high for the day. We couldn't break through that. Came back down to the unchanged level, found some support, came back up to R1 again, and then drifted off going into the close. Here's the intraday chart, where we were seeing a little bit of weakness in the initial overnight session. Then we saw a bit of a recovery with the futures going positive. Then here's the day that happened, and then we're trailing off, and then the futures will pick up and start to trade again. If you're on the west coast of the US, that's about 3 o'clock in the afternoon. If you're on the east coast, that'll be 6 o'clock in the evening. Then we're still seeing value outperforming growth, especially at the end of the day on Friday, where the red line had been going up a lot stronger than the blue line. We want the blue line to really go up. That helps growth. That's buy low, sell high. Those are the big stocks that you want to be able to buy now and then sell at a greater price down the road. Looking at the closing values, growth was up more than value on a closing basis on Friday. They were about the same with the mid caps and the small caps. The growth actually did better. It was down less on Friday. Then we have the growth to value ratio, a 10-minute intraday chart, where it had been showing some improvement while the futures were open. And we saw this again on Thursday. We initially spiked up on Friday and then spent the rest of the day dropping lower. And I have lots of charts to show you this as well. Sentiment, we're still suggesting that there's no fear in the market overall. The VIX ticked up just a little bit, but it's still dropping very low on the line chart, and we're pretty much sideways with the bar chart. But the VIX of the VIX, which measures the volatility of the VIX, it's starting to pick up a little bit. Maybe because there's some uncertainty going on. Here's the VIX RSI 9, where we're starting to get to a real low reading because the VIX has been dropping as the market's been going up, or at least not going down. And so we want to keep an eye on this. Sometimes this will gauge when the VIX is ready to actually change direction. Equity put call ratio continues to fall as the market's been holding up. And then longer term, we have a 253-day simple moving average, which for all of 2022, this was going up, meaning the market was running into a lot of trouble as people were hedging things because of all the choppiness we saw in the S&P. It's now starting to turn and come back down. We don't want to get fooled by this. You can look at other times when it looked like, oh, everything's changing, only to switch back and go in the other direction. But as of right now, this is suggesting that the longer term trend is turning more positive. We're also keeping an eye on the SKU index. This looks at volatility, but where the VIX looks at the money options, The SKU index looks at out of the money options. And when this spikes up, the market is expecting some kind of a big move. And we don't really know what that's going to be, because if you look at the red lines here and then compare it with the price up above, sometimes the market just kept going up. Other times it marked the top. Other times it marked the bottom. So we don't really know what this is telling us right now. It's just that the market is anticipating something. Then we look at the MOVE index, which measures the volatility of bonds, dropping down just a little bit as the VIX has also been dropping. Looking at this fear gauge, where overall we have been declining and we ticked back down in Friday's session, this other fear gauge is also continuing to decline. We're still in a risk-on posture, meaning folks are preferring stocks over bonds as this ratio continues to go up. Advanced decline line studies, not a real big change here, but we're still holding up fairly well based on price. We were flat. Where we're seeing some improvement here is based on volume. If these lines continue to go up, it would negate this negative divergence that we saw going backwards, and that would just help wipe that out possibly. Then we're also a little bit concerned about this. When we had the gap higher on Friday, the new highs, yeah, they were respectable enough to turn the 5-period and 10-period back up. But if we're really going to break into new territory, we want this green line to really go up with a vengeance, and it's not doing that yet. However, the equity put call ratio is still positive even though it declined. We're above 0. Accumulation distribution is above this red moving average. We're still seeing a longer-term negative divergence with the cumulative advanced decline line. It looked like it might be showing some improvement, only to turn down on Friday. The regular advanced decline line also looked to be improving, but turned down on Friday. Then when we look at common stock, based on price and volume, we're still seeing this longer-term negative divergence. If this ratio, or if these measurements really continue to go up, that would negate this negative divergence, but it hasn't happened yet. Then we take another kind of different look at the NYSE advanced decline line, where we're still making a series of higher lows. We broke down below that. Well, we've been able to come back above this trend line. Then the broad market, we look at the NYSE, where it's coming back down to the moving average. The S&P is still just a little bit above its moving average. We're seeing some more weakness with the mid caps and the small caps. Looking at our trend and line studies, here's the ADX. The dark black line, that's the actual ADX. It's above 20 and advancing and above the moving average. The green line finally turned back up. So we do default to the positive trend, but at the same time, be aware of this overhead resistance. Then our shorter term experimental ADX is also showing that we're in an overall uptrend. Volume continues to drop off. That's kind of positive. To see that late day selling going on below average volume, there's not a lot of conviction right now. Short term, where we came right up to the August high. That's the high that we set, a little bit below that. But I drew a blue line here showing that we're really going to have to bust through that. We're going to have to get back above 4,300, and then we're going to have to break through the August high and then close above the August high. Then you can see over the last couple of days where we have dropped below average based on volume. This is a new chart. I just thought this might be kind of interesting. We go back to early 2022 with the all-time high. That's what ATH means. And then when we finally started really tanking, and then we hit that low in October of 2022, we fell. Where's the number? We fell 27.46%. Now, I draw these lines myself, and I had to readjust them about 35 times. So the percentages, they're not exact right there. You move these lines just a little bit, and it gets all crazy. Now, from that October 2022 low, based on the closing basis, we have now climbed over 20%, signifying that we might be in a new bull market. On an intraday basis, we've climbed over 23.5%. Not that bad, considering how bleak things look at times. We're looking at our moving average study. We turned down with the 20/50, and we're slightly lower with the 200-day moving average. The Stochk RSI, still extreme positive, as is the Williams percent R, the CCI 14, and the CCI 20. So we are overbought in the short term. The stochastics also confirming that. Short, intermediate, and long-term stochastics are extreme positive. The force index is not extreme and is actually one of our shorter-term indicators that seems to be behaving a little bit. Intermediate term, we're still above the dashed line with the balance of power. The go, no go system has the darker blue bars. Those are positive. The TTM squeeze continues to advance. That's positive. We're right between the second and third standard deviation on this chart, suggesting that we're still a little bit overbought. PPO study, positive in the long and intermediate term, still positive in the short term, but we did decline. The Arun indicator, and I could have included this on the overbought signals. Other times when we start to see a reading as high as we're seeing right now, a lot of times that can mark some kind of a top in the market. So that's another thing to be aware of. The S&P 500 McClellan oscillator above zero, but it did decline. The NYSE McClellan oscillator above zero, but did decline. The summation index based on price is now crossed above zero, and we're looking a lot more positive based on volume. But when you take a broader measure of the summation index for the whole NYSE, we went up, yeah, but we're still seeing this negative divergence longer term. The Swenlin trading oscillator based on price and volume, even though they're both above zero, they did turn down. The PMO is still looking positive overall. We've turned up based on price as well as volume. The PMO study, we're not extreme with the percent of PMOs that are rising, looking a lot better with the buy signals and also going up with the PMOs that are above zero. The Elder's Impulse system for the S&P has now switched back to neutral. This is not a real friendly looking bar. We opened, we went up, came down and closed below the open. So even though we had an up day, we ran into that resistance and then started to fall back. But the parabolic SAR system still has the dots underneath, so that is positive. The slope indicator is positive, as is the MACD. We look at all of our oscillators and they're all going higher, including our longer term oscillators. The Sean trend meter is still extreme positive. And we're seeing this negative divergence with the BPI longer term, but it is showing some improvement. If we can break above the 4,300 level and the August high, we would want to see this BPI really start to go up and take out this negative divergence. The chicken money flow declined, but it's still positive. The NYSE bullish percent index has crossed back above 50 and showing some improvement. The money flow was pretty much flat, but still above 50. The ultimate oscillator was flat to slightly down, but above 50. The vortex was flat. The green line still on top. That's positive. We're seeing a little bit of weakness in the Chaikin oscillator, but it's still above zero. The RSI 14 period still looking good and not extreme. We could be getting a little extreme based on the 9 period. This is just an inverse of the VIX chart, pretty much. On balance volume, above the moving average and advancing. That's positive. Then longer term, we were starting to see a little bit of improvement with the 200-day moving average and the 50-period moving averages. Those are stocks inside the S&P that make up the index. They were starting to show some improvement, but now we're rolling over again. The Copic curve and the Pring bottom fisher continue to generate buy signals. Our Fibonacci studies, we're still above this 4170 level, and we're above this we're just below this 4313 level. We're just a little bit below the 61.8% retracement level. If we break a little bit above that, that's also the August high. Short term came right up to the August high, didn't quite get up that high before we started to come down. Going back to a longer term chart, going back to the all-time high, we still have a lot of room to run if the market goes up. If we start to fall, we'll be watching these other levels for possible support. This is also positive. We broke above this trend channel that is sloping down, and so far we remain above it. The longer we stay above that, the more positive it is. Our different charts are positive across the board. The Heiken Ashi is good, the Kegi is good, the Renko is good, and the 3-line break is good. Point and figure chart, no new signals here, but we did draw in a new X, and that's always a good thing if you're positive. And see how it's matching up with what's already happened in the past? Kind of interesting. Looking at some different indexes, the equal weight is still underperforming the S&P. We're still seeing a longer-term negative divergence between the Dow and the transports and a shorter-term negative divergence with the utilities. The Dow transports continue to underperform, even though it looked like they could be improving. And the equal weight stocks, which When this ratio goes down, that means more stocks are participating. Well, this ratio is starting to go back up. The Dow is still above its 50 and 200-day moving averages, and we're right below this R1 resistance level. The diamonds still remain positive. The NASDAQ came right up to this R1 level and has bounced back down. And we're just a little bit above this 50% retracement level. But on the negative side, the cumulative new highs minus the new lows continue to decline. But when you take the raw score, we're still above zero. The longer we can stay above zero, the more chance this line has of turning up. With the NASDAQ 100, we never got up to the resistance level, but we're also seeing a retreat from these higher levels, even though they had a good day on Friday. But the Elder Impulse system for the Qs remains at neutral. We're still slightly above the 61.8% retracement level. And the BPI ticked back up just slightly for the NASDAQ 100. The small caps still in an overall negative downtrend. Saw some really big upward moves above R2. Now we're coming back down, and at this point, R2 is acting as support. And then when we look at the Russell 2000, we're starting to get extreme with the RSI, and now it's coming down, but the MACD is still positive. Earlier in the year, when we were coming down, this green line here was a support level. We broke through that. We found other support at a previous low. Now that we're starting to go back up, what had been support now becomes resistance, and the small caps are having a really hard time breaking through that. And the small caps are going back to underperforming the rest of the S&P, where it looked like they had been improving. The Elder Impulse system for the small caps has switched to neutral. Then the small cap growth versus value still in an overall uptrend, saw some weakness and then a little bit of a decline on Friday. This is a new chart, and I should have put S&P 500 on the top. The sectors that we look at are weighted, which means the big companies, they have more of an influence on the sector. Well, just recently, I just came across this. We have a discretionary sector and a staples sector that are equal weight. And we can compare that to the other discretionary and staples sector studies that we have just to see if it gives us any clues. And then we have a ratio down here at the very bottom. The mid caps gave us a recent death cross. Now it looks like they're back to giving us a golden cross, broke above R2, but then came back down below that. And the Elder Impulse system for the mid caps is neutral. Mid cap growth versus value, seeing some weakness, and we were flat to slightly down on Friday. When you look at the broad market and compare it to shorter term bonds, the stocks are continuing to outperform bonds. Then we take another broad market look and look a little further out at bonds, and that is also holding up quite well. The tech sector compared to bonds, just blowing them out of the water. Keeping an eye on the financial sector, where we were pretty much unchanged, but we're in an overall downtrend. The financials are back to really underperforming the S&P, and the regional ETF is starting to show more weakness again when compared to the financial sector. Keep an eye on bonds. Yields were up slightly, and bond prices were down slightly. We compared the 1 to 3 month T-bill, which is pretty much cash, with further out bonds. We want to see this really starting to decline. It's going back up. So this is a little bit of a concern. Maybe it'll get worked out this week with CPI, PPI, the Fed, and retail sales. Maybe something will happen to help turn this ratio back down. The riskier bonds are still doing better than the more conservative bonds. People are willing to take on more risk. And then we're still a little concerned about this when we look at the S&P and the long-term bond ETF. That relationship is really disintegrating, meaning they're having a tendency to go in opposite directions. Now we're starting to see some weakness in the shorter-term relationship, and the spread between the red line and the blue line is still very wide. We don't really know what this is telling us yet, but there's a lot of uncertainty going on right now. Then when we look at the S&P and compare it with bonds, still suggesting the stock market, anyway, is thinking that we will have a soft landing. This is an inverse of that same chart showing how bonds are really underperforming the S&P. Growth is showing some strength, some weakness, came down to this moving average and bounced back up. Value showing some weakness, bounced up a little bit, and then showing some more weakness on Friday. This is a new chart, and this is based on some of the earlier charts that I just added. What we have above is the value to growth ratio. Usually I do growth to value ratio first, but if you look at the black line and then compare it with the 10-year treasury yield, which is the red line, look at how they have a tendency to go in the same direction. Sometimes that can give us some insight. And then on the bottom, we take that ratio and compare it to see how strong these two are acting with each other. And they do have a very strong correlated relationship. Then this is another concern. We're breaking above where we had been at right before the great financial crisis back in 2007. We broke above that. We're starting to come back down. We're wondering, is this telling us some kind of a warning that we need to watch out for? Longer term, this is looking more positive. You see the black line is trying to go above the red line. That could be quite long-term positive. When we switched over and went negative was right at the beginning of 2022. And we all know the mess that we've been through since then. If this can finally go back above the red line and then stay above it, that could really turn things back more positive. An update of our possible positive scenarios. The Qs turned back up slightly compared to the S&P, saw a bit of a rebound with discretionary and a bit of a rebound with large cap growth compared to large cap value. Our growth to value ratios, large cap, a little bit of improvement with the mid caps, still seeing some weakness with the small caps. The S&P to utilities ratio declined a bit on Friday, but is still going up overall. This could be positive for the S&P. Then when we look at the Amex, the NYSE, and the NASDAQ, and we take a 5-period moving average of the highs minus the lows, we're still above zero. The longer we can stay above zero, the more positive this chart will look. Then we look at the 50-period moving average of the new highs minus the new lows. It's probably hard to see, but the red line is turning back up. That's because the black line on this chart is above zero. The longer it can stay above zero, the more this previous chart will turn back up and start to go higher. Looking at growth versus value at the S&P 500 level, we have been seeing some real strength, but now it's starting to show some weakness. Something to be careful of. We're not really getting anything from the 2-year treasury yield. It spiked up, came down, now it's coming back up. Easily, this could go in and create another spike, and we don't know if that would really give any support to stocks. But this can give some support to stocks with one warning sign. We're spiking with the staples to S&P 500 ratio. That's really falling. Other times when this really fell, look at what the S&P did. Here's the warning. When we spiked out and started to go down, we had already climbed pretty significantly with the S&P. And as this ratio has been going down, we've been chopping more or less sideways. So we really want to see this break above that resistance with this ratio continuing to go down. And that would suggest a much more positive picture. So what's our outlook? And this should be for Monday, June 12th. I didn't get a chance to change that. We're still dealing with earnings season. We have quadruple witching coming up at the end of this week. That can produce for some really roller coaster rides. The technicals are still positive. We still have some negative things to freak out about and some negative divergences, but a couple of good days like we saw earlier this week, that could really help the overall environment. We have the Treasury budget coming out on Monday, and then the whole list of geopolitical events. And unless something flies in from left field that's either on this list or hasn't come on the list yet, the market is going to continue to be fixated on inflation and interest rates and what in the world is the Fed going to do. Here is the economic calendar for the upcoming week, where Tuesday we're going to have CPI, Wednesday's the PPI and the Fed announcement at 2 p.m. Eastern, retail sales and industrial production and capacity utilization on Thursday, and then consumer sentiment on Friday. So it's a pretty heavy week. Looking at the Stock Traders Almanac statistics for Monday, June 12th, we're negative. We're well below 50%. So for all of them 3 indexes that we track. We're on the 8th trading day of the month, but when you look in a pre-election year, the green dashed line is actually going up slightly. Then when you look at tech or the NASDAQ, where the other stocks you like to sell in May and go away, and I never bought into that. Well, when it comes to the NASDAQ, it tends to do better going into the mid part of July. So our scenarios can't really go with the down one now unless you're super, super aggressive and just totally convinced that this overbought condition and the resistance above us is going to just turn everything and have it go lower. We still default to the positive side, even though we have this resistance above where we're at. And we can't go with the sideways right now because our ADX, both the short and the regular ADX, are showing that we are trending positive. Some warning signs. The new highs and new lows for the S&P, they're not expanding, but they are showing some improvement. The BPIs in the S&P, it has crossed back above 50. That's a little more of a warning sign because they're negative diverging right now, but they are showing some improvement. We got a lot of stuff we could worry about. Remember, the market likes to climb a wall of worry, and I tried to point those things out. The VIX is still showing a lot of complacency. There's not a lot of fear right now. The cumulative new highs and new lows on the NASDAQ, even though the NASDAQ's going up, these continue to fall. The 3-month yield is above where we were at back in 2007, right before everything fell apart. Small caps generated a recent death cross, but they've seen some recent strength, especially Tuesday and Wednesday of this past week. Earnings season continues, and at some point it might actually be over with. The positive signs. We do have these seasonality and setup signs that remain for the whole year. The Copic curve and the Pring bottom fisher are still generating buy signals. The S&P is above that downtrend channel upper line. The longer it stays, the more positive that will be. We have a risk on posture, meaning stocks are more favorable. Lower price levels, as well as moving averages, Fibonacci retracement levels, or some kind of a level in a different index may provide support if we start to fall. The S&P is outperforming utilities. That ratio, even though it declined on Friday, is going up overall. The NASDAQ and NASDAQ 100, they're just really doing well right now. And the Staples to S&P 500 ratio is declining. To say that another way, the S&P is outperforming Staples, and sometimes that really helps the S&P. The mid caps are in the process now of generating a golden cross. And then small and mid cap growth, they're showing some strength, but we want to see more follow through with that. So our conclusion, the S&P, it's positive. A lot of things we could be negative about, but some of those negative signs continue to improve. Now we have another down day or two, and that takes that improvement right off the table. Short term, we're positive, but we continue to be overbought. Intermediate term, we're positive and a little bit overbought. Long term, we still remain positive. So thank you. I really hope that this was okay. If you feel like it, let me know. If you thought you could see the videos okay, if my sound was all right. I don't have to do any editing with this video, so I can put out these types of videos a lot quicker, but I like to do as good a job as I'm capable of doing. I will look at preparing the weekly video, the intermarket analysis video, and the deep dive video. So I hope you have an amazing weekend, and I will talk to you in the next video.